As much of the nation digs out from a wicked winter storm, the prospects for the REIT industry look considerably brighter. Here to talk about where REITs are today is Brad Case, NAREIT's Senior Vice President of Research and Industry Information. So Brad, how did REITs do in January?
Well, it was another very strong month. REIT returns were up 3.64% for the month. It's an interesting part of the market because actually REIT cash dividends have really continued to maintain a fairly high level. They're at 4.18% now over the REIT industry as a whole. And the reason that the cash dividend has been able to stay strong even though REIT stock prices have recovered so dramatically is really that we're starting to see improvement in real estate operating fundamentals, and that's translating into better earnings and therefore stronger cash dividends. So investors are really aware of that. It's actually a very interesting part of the cycle because we're now exactly where we were at the end of September of 2008. And that's an important date because in October of 2008 was the beginning of the liquidity crisis. But September 2008 was already a year and a half into the downturn that was associated with a softness in the broad economy. So in a sense, we have finally completed the recovery from the liquidity crisis. And we're just about to start the recovery from the economic downturn itself.
And you've written a lot about this subject on seekingalpha.com, and you have a recent post asking if the commercial real estate downturn is in fact over. Mm-hmm. In that post, you seem generally optimistic that the worst is behind us, but you also urge caution. Why is that?
One of the points that I make is that there would be plenty of bad news about the commercial real estate market going forward. And the reason for that is that many properties are owned by investors on the private side of the market that paid too much for properties at the peak of the market, took on too much debt. Their loans are underwater, and that doesn't affect them until the loans become due. Those loans will become due in the 2012, 2013, 2014 time period. At that time, many of those owners will become distressed sellers. So there will be loan defaults going forward. There will be reports of people of investment managers on the private side that have lost everything or much of their investment. But investors have to keep in mind that the bad news on the private side of the market will continue to be good news for publicly traded REITs and their investors because they have access to capital. They'll be in a position to take advantage of those distressed sales to buy properties going forward at good prices.
And speaking of deals, of course the big news in the industry right now is the merger of equals between A&B Property Corporation and Prologis. What did this deal say to you about the market right now, and do you see similar type mergers in the future?
It may well be that there will be other mergers going forward between publicly traded REITs, but if that happens at all, I don't expect it to be a dominant story. The dominant story, I think, will be the acquisitions by existing publicly traded REITs of properties and whole portfolios on the private side of the market, very much like what we saw in the early and mid-1990s. There were IPOs, there were mergers back in that period. But most of the story, and many investors don't realize this, most of the growth of the publicly traded REIT industry in the 1990s was acquisitions by existing publicly traded REITs of properties and portfolios from the private side of the market. So the A&B Prologis deal is a very interesting deal. Investors generally think that there appear to be very strong synergies, operating synergies between the two companies. So the merger seems to have gotten a very good reception, but I'm not sure that we'll see very many more like it.
Great. Brad, thank you very much. For REIT.com, I'm Matt Bichard.